The Brussels Report podcast.
Welcome to the first podcast of BrusselsReport.eu. Brussels Report is a new magazine dedicated to covering news and analysis on the Eurozone, the EU, and once in a while also investment issues. My name is Pieter Cleppe. I'm the editor-in-chief of BrusselsReport.eu, which aims to be a platform for people across Europe and outside of Europe to provide their opinion and analysis to discuss these issues. I'm more than happy today that I have with me Lex Hoogduin, Professor Lex Hoogduin, who is an economics professor at University of Groningen in the Netherlands. Before that, he used to be the chairman of a big clearinghouse in London, LCH.Clearnet. And I would say most importantly, back in the days at the beginning when the euro was founded, Professor Hoogduin was the advisor to the first president of the European Central Bank, Wim Duisenberg, a Dutchman. Now, Professor Hoogduin, welcome. Let's start with it right away. So, at BrusselsReport.eu, we have made the point, and several commentators have made the point that governments are ever more dependent on the European Central Bank. To what extent do you think that is actually correct, and to what extent that is the case?
First of all, thank you, Peter, for having me here today, and I'm honored to be the first guest in your hopefully very long podcast series. Coming to your question, yeah, I think that is right. As we speak, I think quite a number of governments are dependent on the ECB, and in the sense of being dependent on very low interest rates for having their debt sustainable.
Yes, and in Europe, what would be the governments that you would single out that are, let's say, obviously dependent on the ECB to the in the sense that if you would have a material increase in interest rates, that without the ECB, that they would be very close to default.
Yeah, I would mention six countries that in any case are on that list: Greece, Italy, France, Spain, Belgium, and Portugal. Not that they would immediately default, but that they would trigger substantial financial instability issues with potentially an economic crisis. And as we have seen in such situations, you don't need to actually default for having also doubts about the sustainability of the euro itself.
And going back, what are sort of the, let's say, the pivotal points where things went wrong? If you look back to the history of the euro.
Yeah, well, when the euro was founded, it was already clear that a number of countries had already at that stage, of course, a debt way above 60%, and only in some cases very recently started to decline in the direction of 60%. So when the euro started, it was emphasized by, for instance, the ECB that those countries should continue, as it was formulated in a very diplomatic way, on their way of bringing these are my own words, their government debt further down at an appropriate pace. And all this was stimulated by the Stability and Growth Pact. Now, the problem is that from the very beginning, the enforcement of the Stability and Growth Pact was problematic. and also countries, even the big countries, did not fully comply with it. I recall 2003 to 2004 that Germany and France did not really comply. Nevertheless, I would say until the financial crisis of 2007-2008, this was not visibly hampering the functioning of the ECB. The ECB's main objective is price stability, and it was quite successful at achieving that primary objective. And the situation around government deficits and debts were a little bit in the background because of that. But that changed quite dramatically, of course, during the financial crisis of 2007-2008 and the aftermath, which turned that crisis into a euro crisis. And at that stage, when Italy and Spain came under pressure, the governments of Italy and Spain came under pressure. Mario Draghi spoke his famous words: "The ECB would do whatever it takes to save the euro, and believe me, it will be enough." And that led to the introduction of the OMT program, and that calmed down, let's say, the pressure. But nevertheless, in the aftermath of the crisis, debt levels were not convincingly reduced in many euro area countries. And then, more recently, I think the next vital point, using your words, was the outbreak of the Corona crisis. During the Corona crisis, it became clear that countries had to spend a lot of money, government expenditures, to cope with the Corona crisis, and that has led to a further deterioration of the situation with their public finances. I think rightly the enforcement of the Stability and Growth Pact was not strong anyway, but formally there was this enforcement, has been suspended. And again, I think rightly so. But the impact has been that now the countries that I just mentioned have also debt levels that are quite problematic from a sustainability point of view, or in other words, their sustainability of their government debts depends on interest rates remaining very low for quite a long time, and for the ECB to continue its QE programs to ensure that.
And would you agree with Mr. Borio of the Bank of International Settlements? So he maintains in a paper that that indeed central banks at the global level, so definitely in Europe as well, are responsible for the low interest rates or for the long-term low interest rates environment? Or would you say, yeah, it's probably not only central banks, there are other factors that also suppress interest rates?
Yeah, I think this is a very important and interesting debate. But before I say something about it, let me stress that whatever the reason is that interest rates are very low at this moment, the fact that now government debts are so high in several countries means that, again, for the sustainability of those debts, they have become dependent on these rates remaining very low for quite some time.
Yes.
Irrespective of what the reasons are for these rates being very low. But let me nevertheless say a few words about that. There are basically two two schools here. The one school is that that central bank rates are very low because of the so-called savings glut. So that there's an excess ex-ante-saving in the world, often and mainly linked to the aging of the population.
Mm-hmm.
And that central banks, as it were, follow that fundamental factor, and that equilibrium interest rates, or sometimes called natural rates, are very low, and some even argue that they are negative. The alternative explanation is that this is not the main factor, and it is central banks themselves that have, via their policies, contributed very strongly to ever falling interest rates, and to them being now as low as they are. Now, my own view is that first of all, interest rates are the outcome of a complex process, and there's not just one cause for developments. But looking at all the factors, my own view is that it is quite plausible that the monetary policies of central banks and the monetary policy regimes of central banks are a dominant factor in this development. So I'm closer to Claudio Borio than to Ben Bernanke in this respect. But let me repeat at the end of this answer that going forward, it is important to analyze on whether you could indeed, with high confidence, assume that these rates will remain quite low for quite a long time, so that you don't have to worry about the sustainability of government debt and also private debts.
Thank you. And then another question, indeed. In I think it was in 2010, or at least during the Euro crisis, the Federal Reserve, the American central bank, has been active providing so-called swap liquidity to the European financial system. Mm-hmm. Some people have claimed that this has been more important than the words of Mario Draghi and the bailout packages decided in Europe at the Eurozone level. I mean, what is your opinion about this? And I think this is quite important, because if we would see a rerun of the Euro crisis, then perhaps once again Washington DC may have to come to the rescue.
Yeah, I find it difficult to, let's say, put a quantitative measure on what was it more important. I do think that Mario Draghi's remarks were very important, but at the same time, you make a very important point about the role of these swaps. But if I'm correct, these swaps were already necessary to provide during the financial crisis, and that has to do with the fact that the international financial system is really a dollar-denominated system. Mm-hmm. The Federal Reserve is, as it were, the central bank of the world, given the globalized world. And if the Fed would not have provided these swaps, this would have been very detrimental, not only to the Europeans, but to many more countries around the world. And we have seen during the Corona crisis that again these swaps had to be activated again, mm-hmm. because again the international monetary system is still a dollar-denominated system. Interestingly enough, but I don't want to elaborate too much on it, because it's a bit a side topic from our topic today. The pattern of let's say where the liquidity from the Fed had to flow, indeed during the Euro crisis, was to Europe, but now during the Corona crisis, it was more in the direction of Asia. So that's an interesting pattern also for researchers. But as to your question, I think it is true that Mario Draghi's words, in my view, were very important, but it was not just his words.
Do you think, to press you a little bit on that, in case European politicians would really not be able to sell more bailouts and more monetary activism to the European population in order to keep the euro alive, do you think the Federal Reserve is even able to, let's say, perhaps expand these swap lines so to keep the Eurozone alive? Or would that not be feasible? Would that be the end of the Eurozone if there's not sufficient political consent left
I think
in Europe?
Yeah, that would be the end of the euro. Absolutely. I think the issue here is, in the context of our topic, can you survive a situation where there would be upward pressure on interest rates, which would put upward pressure on government debt and government interest payments? Can you cope with that? And if the Europeans cannot cope with that themselves, I don't see that the Fed would be able to help them out.
And what if there's this pressure? Let's assume a situation that's perhaps not so unrealistic, huge economic damage becoming apparent as a result of the COVID crisis in Europe, the ECB dramatically stepping up its monetary activism, and the balance sheet of the ECB, even, I think now it's already at 70% of Eurozone GDP, going to, 150% to GDP. And is there a situation conceivable where we finally see inflation going out of control, forcing the ECB to hike rates, while this is not necessary for the Fed to do? Is that conceivable?
Yeah, I think we can leave out the Fed. That complicates the argument.
Sure.
I think we can simply analyze whether the assumption that interest rates will remain low forever, whether there are scenarios where that will not be the case, and assume that we are in such a scenario, and I will elaborate on such a scenario in a minute. But let's assume we are in such a scenario. What then would be the position of the ECB? So let's assume there is inflationary pressure. Then at that point, the ECB should, according to its mandate, should increase interest rates and give priority to maintaining price stability. That could trigger, if the needed interest rate increase, or the perceived needed interest rate increase, is quite significant. That could create the pressures that we discussed earlier on the sustainability of government debt, and could create a type of pressure that we have seen in 2012 in particular. So then the question is, are there scenarios where we would have increasing inflationary pressure, re-emerging inflationary pressure, and I would argue, and/or increasing interest rates, upward pressure on interest rates from other sources than inflationary pressure, so triggered by the markets. And I think for both scenarios, I think there is, in my view, they are plausible that can happen. For a re-emerging inflationary pressure, I think we can refer to the recent work of Charles Goodhart and Manoy Pradhan, who have written a book, The Great Demographic Reversal, where they argue that in the coming years, and can already be in the medium term, inflationary pressures will re-emerge because they argue in line with the, let's say, the mainstream interpretation of why interest rates are so low, that we had a period with a savings glut due to demographic reasons, that we also had the downward pressure on wage rates because of the emerging market economies, China in particular, and also in the advanced economies, increased female participation in labor markets that put downward pressure on wages altogether, and downward pressure on wages translated into downward pressure on prices. It also led to a lower influence of unions, and so on and so forth. And they argue that these trends are reversing. And they document that in a recently published book, so that we get upward pressure on inflation. Is this the most likely scenario? I would argue that it need not be the most likely scenario, but if it is a plausible scenario, then it is something that you have to take into account into your policies. Then on top of that, I think is a factor that I would add to the Goodhart and Pradhan scenario. I would argue that given the very low interest rates at the outset, at the moment, and given the very ample liquidity in the system at the moment, it would be quite difficult for the ECB in this case to stop an inflationary process, or to counter an inflationary process by just gently increasing interest rates. The ECB policy is so far from being contractionary, being tight, that if you have to react, and if interest rates are then still at the current level, you have to react very strongly. So that's for interest rate. Sorry, for inflationary scenarios that may trigger interest rate increases. I think it is also possible that we will have upward pressure on long-term interest rates, in particular, coming from what I would call market dynamics. If we look back, and we have discussed a bit the current low interest rate levels, and we have discussed what the causes are for that interest rate level, but irrespective of the causes, what we have seen is that over the past 35 years or so is a declining trend in long-term interest rates. And for financial market participants, that meant that in particular in fixed income, their total return was not only positively determined by the level of the interest rate itself, but also by continuous capital gains because of the falling interest rates. And that has made fixed income investments very attractive, has given tailwinds to fixed income investment, has allowed the emergence of very large asset managers like BlackRock and PIMCO, and so on and so forth. And it, of course, has also given a boost to other asset classes than just fixed income, but fixed income in particular. Now, one thing is quite certain, I would say, going forward, is that the next 35 years, in this respect, will be very different from the past. It is unlikely that interest rates will continue to decline at a pace that we have seen them falling over the past 35 years. That's almost impossible. So that means that we go into another regime. And if you are an investor, let's say in Dutch government bonds, AAA, with a slightly negative interest rate level, and you, at the moment, it is not very likely that you will have huge capital gains going forward. The question is, why should you, if you are free to decide, why should you keep them in your portfolio? Why not restructure your portfolio towards other asset classes? If more and more investors are starting to realize or are starting to conclude that the future for fixed income is not that bright, like for instance Warren Buffett has already expressed publicly, then there may at some point be more and more investors again who have the possibility to do so to sell their government bond portfolios, which would then put upward pressure on the ECB, among other countries, among other central banks, and they then have to buy more and more of those bonds to keep interest rates at low levels. That in itself could trigger political unrest in countries where very low interest rates are hurting savers and pensioners in particular. That could put pressure on the ECB to not continue with these QE programs. The question is also, how flexible are these QE programs for dealing with sudden bouts of selling? We have already seen recently that it took time for the ECB when there was upward pressure in the US, then also spilling over to the euro area. The ECB waited until there had been a governing council meeting for reacting. It allowed interest rate to go up. Well, if in future we get huge or larger pressure on interest rates, it's a question of whether the ECB will be able to withstand that pressure. It may also trigger new legal cases against the ECB for not being proportional. So if you add it all together and you're an investor, you don't wait until all this happens, and at some point investors may start to sell, trigger a critical mass, and that could then lead to a difficult position for the ECB. So in summary, assuming that interest rates will remain low forever and that the ECB will always be able to keep them as low as they want them to be, I think is not very responsible way of dealing with it. I think that these scenarios that I just pointed out are plausible.
Upward pressure from the market. Now, Lex, to press you again, what if the IMF comes to the rescue? Recently, President Biden in the United States overrided the refusal of Trump, or reversed the refusal of Trump to let the IMF expand the SDR, which are sort of, let's say, a global currency, you could say. With the idea was to give more liquidity in this way to struggling governments in developing countries. Now, perhaps you could conceive a scenario where the SDRs are expanded, but also to help the Eurozone, because a collapse of the Eurozone would also hurt the international banking system. Or is that not conceivable, or is that only, let's say, in the margin that this could make a difference?
I think this, if this were to happen, expansion of the SDRs, that makes a scenario in which there will be inflationary pressure more likely. So it doesn't help; it does hinder. I would argue. So I think that this doesn't help at all. The situation is what happens if there is inflationary pressure, and are there scenarios in which there will be inflationary pressure? As said, I think that it's plausible. Such scenarios are plausible, both for structural reasons and also for quite high liquidity at the moment, very low interest rates at the moment. So the question is, what would happen if inflation starts to increase in the euro area in the coming years. And then I think what the ECB will do is to try to keep interest rates as low as long as they can by continuing increasing QE if they can. And one of the things that may well happen is that the ECB is currently conducting a strategic review. And one of the outcomes of the strategic reviews may be that the ECB will in future target average inflation, like the Fed has concluded recently. And that means that if inflation starts to increase, that the ECB will say, let's not react immediately. Let's continue with keeping interest rates very low, because we want to now run a couple of years where inflation is above target rather than below target, as it has been the past. What is it, 5 to 10 years, whatever it is. So that means that again, a scenario in which inflation will go up is a plausible scenario. Now, for the sustainability of debt levels, that initially may be welcome, because to the extent that inflation is unexpected, it will reduce. It will not lead to higher interest rates, and it will eat into the debt levels, the real value of the debt. But yes, at some
which point, they would like it. Yeah.
But at some point, the ECB will be forced to react, and will then be, given that their policies are so expansionary and that inflation has already gone up very high, it's in a very difficult position. It cannot stop inflation then by just raising interest rates very modestly. It has to react very sharply. It's a kind of situation that we had at the end of the 70s when Paul Volcker had to stop an inflation in the US, and then that's then the point at which the euro comes at stake, and where the ECB will be under very strong pressure not to raise interest rates, and then we are in a scenario that we have an uncontrolled inflationary process, or the ECB reacts, and then you will have a financial economic crisis and pressure on the sustainability of the euro. Now the question is, at that point, have actions been taken to cope with the current high debt levels? If not, then I think this is a deep crisis, and that is the moment where either the euro will fall apart, or we will move to a fiscal union, and then later, step by step, followed by a political union, and probably debt will be restructured and to a certain extent be forgiven as well.
Mm-hmm. Okay, maybe before we wrap up, one more question. You discussed how there could be sort of market-driven dynamics, driving inflation up, right? But what if these alternative cryptocurrencies start to play a role? At least that is the hope of many proponents of Bitcoin. The idea is that people would start paying each other in cryptocurrency, Bitcoin, and thereby fiat money, government money would become less attractive. Do you think that is far-fetched, or do you think that's actually realistic? As someone who actually knows the financial system, both in academic terms and in also in practical terms, having served in a clearinghouse, you're more than experienced to be able to judge the potential of this whole crypto development. And I should add to that, if crypto would not be able to do that, what about old-fashioned physical gold and silver? Would that not constrain the ability of the ECB to expand the money supply given that people can always buy gold and silver to store their savings that they would otherwise store in banks.
Yeah, it's very good and interesting question. First of all, on Bitcoin, and other cryptocurrencies, I don't think that they, in the current situation, can be a realistic alternative for let's say the euro, because at the moment inflation is very low, interest rates are very low. So the question is, if we come in a situation where inflation is really starting to accelerate and the sustainability of the current financial system would become at stake, then I think it may be an alternative, but not as long as the ECB is able to keep interest rates low, and as long as the market consensus is that interest rates will remain low forever. And so I don't think that only in a real crisis will people move to another untested and so far still also unstable, far more unstable than the current currencies, unstable cryptocurrencies. So I don't think so. But again, the current, if no action will be taken on the current high debt levels, then I think we live dangerously, as it were. It's a bit like somebody who eats and drinks too much, and you have people who become 110, living dangerously, as it were. But many people do not survive that, and you are vulnerable. And I think the current euro and euro area is vulnerable, and even more so after the Corona crisis. And the basic question is, do we want to live with that? Are we really convinced that there will never be inflationary pressures? Or do we take action? If we don't take action, then we run the risk of really an existential crisis again. And in such a situation, then it may well be that people start to move to other currencies, cryptocurrencies, among them. You also asked another question, which deserves, I would almost say, a complete podcast issue, separate podcast, and that's the question of basically the issue of the strategic review of the ECB, and that's the question of, are the current monetary policy strategies, the inflation targeting strategies that have developed since the 1980s, are they sustainable? And we ended up with these strategies since the early 1970s, the end of the Bretton Woods system. In the Bretton Woods system, there was, be it not perfect and only partial links between the currencies and gold, but you had anchored systems. And since the 1970s, early 1970s, we have entered a fiat money system where you could argue that, let's say, that allowed the enormous explosion of the money supply, an explosion of the financial sector, explosion of debts and credit levels.
The end of the link with gold since 1971.
Yeah. So that has allowed what I used to call a great financial expansion. And I said, it's a topic as such for me that has had deep implications for the role of central banks and monetary policy. And you could argue that if you look into monetary history, there's always a question of money being provided too easily, and then you end up with inflation and financial crisis, or if you have a situation in which the monetary system is not elastic enough, is too rigid, then you will end up with liquidity crisis and also financial crisis. And economic history is a bit finding a balance and rebalancing all the time. And we are now in a period of fiat money, so money that is highly unanchored. We know from history that fiat money systems tend to be unstable. They on average survive a couple of decades, and then most of the time, because of over issue of money, they collapse. And what we have seen after the unanchoring of money since the 70s is this blowing up or rapidly increasing of the financial sector.
Well, but of course now will be different, right?
Sorry?
I'm saying now it will be different.
Yeah, I cannot see you, but I assume that you have an ironic expression on your face now. Yes, this time will be different.
Well, okay. Lex, I think we'll have to wrap it up here, but I thought that was a very interesting conversation, and I was more than happy to be able to ask you some pressing questions that I always had when it comes to the euro, because I think we have to be humble. It's dangerous to predict it will collapse in 1 year, or that inflation will be unleashed very quickly. I mean, I've never made these predictions myself. Many people have. But nevertheless, I've always been very, very critical to the path that has been chosen. And I think it's great to hear your expertise, to shine a light on that. So that's it. Thank you very much, Lex, and let's definitely stay in touch.
It was my pleasure, and indeed, let's stay in touch.
Thank you.
The Brussels Report podcast.